Hey everyone, welcome back to The Explainer. If you've ever looked at the financial markets and thought, how on earth are everyday retail investors throwing around massive positions with such tiny amounts of capital? Well, you're definitely in the right place. Today, we're breaking down the complex mechanics of retail trading, focusing specifically on leverage, contracts for difference, or CFDs, and the really crucial European regulations that govern them all. We're going to take some dense financial source material and unpack it together so you can see exactly how these mechanisms work behind the scenes.
But here's the real question you've got to ask yourself. Is trading leverage this incredible, powerful financial tool that levels the playing field for the little guy? Or is it just a really dangerous trap waiting to snapshot on the inexperienced? This dual nature, the incredible reward versus the massively amplified risk, is the core narrative we're diving into today. By the end of this, you'll have a crystal clear understanding of exactly why regulators view these tools with such caution.
So here's our game plan for today. We'll quickly cover the mechanics of leverage, compare a 130 to a 1-500 ratio, and look at the real risks of CFD trading. Then we'll dive into ESMA's investor protections, the total ban on binary options, and finally wrap up with how to actually choose your trading strategy. Let's get right into it.
All right, Section 1, the mechanics of leverage. So what actually is leverage? Well, essentially, it's borrowing capital from your broker so you can get way more market exposure than your own cash would normally allow. Let's break down the basic math using an example straight from the European Securities and Markets Authority, or ESMA. Say you've got leverage of 20 to 1. That means for every 5 euros you put in, your provider gives you 100 euros of market exposure. They're basically spotting you the remaining 95 euros. Just like that, your purchasing power is absolutely multiplied.
Now, in the retail space, leverage is most commonly paired with CFDs, or contracts for difference. These are complex derivative instruments. And what's really fascinating here is that with a CFD, you aren't actually buying the underlying asset at all. You don't own the gold, you don't own the currency, you don't own the stock. You're literally just speculating on whether its price is going to go up or down. And while, they offer amazing instant access to global markets right from your laptop, their highly leveraged nature means they multiply everything. They multiply your profits, for sure, but they also severely multiply your rapid losses.
Moving on to Section 2, 130 versus 1-500 leverage. To really understand why retail investors absolutely flock to these products, we have to look at what I like to call the sticker shock sequence. We're going to compare two wildly different leverage ratios. On one hand, a more conservative 30 to 1 ratio, which is what you usually see in regulated environments, versus an extreme 500 to 1 ratio that some offshore brokers offer. To make this super concrete, let's look at a hypothetical trade scenario from Black Bull markets, trading one standard lot of the euro against the US dollar.
Okay, so if you're trading that one lot of Euro/USD using a 130 leverage ratio, the math dictates that you need to put down 1/30th of the position size. That equates to a required margin of over $3,300. For an absolute beginner who maybe just opened an account with limited capital, that is a huge, maybe even impossible amount of money just to open a single trade.
But now, check out the dramatic contrast. If you flip that to a 1-500 leverage ratio, you only need to put down 1/500th of the position size, meaning your required margin drops to just $200. Think about that. You were controlling the exact same massive position in the market, but you only had to cough up $200. You can instantly see how intoxicating this is, right? It totally opens the door for traders with very little capital to take on massive positions with barely any money down.
Which brings us right to Section 3, the risks of CFD trading.
Let's rewind a bit to January 2015. This is a very famous, incredibly painful story in the trading world. The euro suddenly and completely crashed against the Swiss franc. It was this violent, unprecedented market movement. And because leverage multiplies your losses just as fast as your profits, and because we didn't have standardized protections back then, well, some retail investors had their margins wiped out literally instantly. But it gets worse. They ended up owing massive, life-altering sums of money to their brokers, way more than they could have ever afforded to pay back. It really makes you ask yourself, what exactly happens to your portfolio if a sudden price drop evaporates your margin in seconds?
That leads us perfectly into Section 4 ESMA's investor protections.
This is exactly where the European Securities and Markets Authority, ESMA, decided they had to step in. For years, they had been issuing warnings about the inherent dangers of CFDs, but the risks to regular investors just weren't being controlled. So, using new powers under the MiFID regime, ESMA essentially dropped the hammer. They enacted sweeping product intervention measures across the entire EU to standardize exactly how these leveraged products are marketed, distributed, and sold.
One of their absolutely crucial interventions is the 50% margin closeout rule per account. Before this, margin rules were kind of like the Wild West. It just depended on your specific broker. But ESMA standardized it. Now, if the total margin in your account drops below 50% of the initial margin required for your open CFDs, the broker is legally obligated to step in and start closing out your positions. It's basically a standardized automatic circuit breaker designed to stop your account balance from eroding all the way to zero.
And ESMA didn't just pick one random number to cap leverage either. They actually tied the limits directly to the asset's volatility. The whole idea is to make sure retail investors face a somewhat consistent level of risk, no matter what they decide to trade. So you're allowed higher leverage, up to 30-to-1, on relatively stable assets like major currency pairs. Gold gets 20-to-1, but when you get to highly volatile individual equities, you're capped at 5-to-1. And the wild, unpredictable swings of cryptocurrencies, those are restricted to a mere 2-to-1.
But here is the really crucial point. Negative balance protection on a per-account basis. This is your ultimate safety net. It strictly ensures that a retail investor can never, ever lose more than the total amount they invested for trading CFDs, period. So if we ever see another extreme market event like that 2015 Swiss franc crash and the margin closeout circuit breaker somehow fails to trigger fast enough, this rule legally guarantees you won't end up owing residual debt to your broker. You might lose everything in your trading account, sure, but not a single penny more. All right, Section 5, the binary options ban.
So, first, let's clearly define what binary options actually are. They're a derivative where you get a predetermined fixed payout if an underlying asset meets a very specific condition within a set time frame. For instance, will gold be above this exact price at exactly 3 p.m. today? If yes, you win a fixed amount. If no, you lose your entire investment. This is completely different from standard vanilla options, where your returns scale up or down based on how far the price actually moves. Binary options don't have any of that nuance. They are strictly all or nothing.
And ESMA's rationale for dealing with these was incredibly blunt. They flat out stated, economically, binary options are inherently like gambling products, which are not suitable for the purpose of hedging. Because of this rigid all-or-nothing setup, the actual data showed that retail investors, on average, just lost money with them. And since there was no clear alternative investment purpose for them, ESMA didn't just put limits on binary options. They completely prohibited marketing, distributing, or selling them to retail investors entirely.
Finally, let's head into Section 6, choosing your trading strategy.
When you're trying to navigate all this, the research outlines 5 critical factors you really have to balance. You've got to ask yourself, what is your actual personal risk tolerance? And what is your specific strategy? I mean, a scalper needs totally different leverage than a swing trader. You also have to assess the inherent volatility of the market you're jumping into, your total account size, and of course, the strict regulatory restrictions in your specific jurisdiction. It is all about balancing your trading ambition with the reality of your actual capital.
I want to leave you with this final provocative thought. Leverage is, without a doubt, a magnifier. It magnifies your purchasing power, it magnifies your potential profits, but it also heavily magnifies your potential devastation. As you look at the markets and weigh your approach, you have to look in the mirror and honestly ask yourself, when you apply leverage to the markets, are you executing a measured, well-researched trading strategy backed by real risk management, or are you simply gambling? Understanding the rules of the game, like ESMA's protections, is your absolute first step toward the former. Thanks so much for joining me for this explainer, and keep learning out there.